What's up, guys? It is 11:30 on a Saturday. It's been a while since I did a financial model for a specific industry. I think on the first of the month, October 1st, I did one for manufacturing, but that wasn't even really specific. So this one is about planning for a used car dealership, and it's for a startup. I mean, you could use it if you're half, into your business already and you want to project out, but it is geared toward someone who's just starting up and is going to finance, but well, you don't necessarily have to finance. But it goes out 5 years, and I've tried to take into account all the major assumptions and inputs that are required if you're going to get into this space. You'll have to do more research on some of the inputs, but I've tried to do as much as I possibly can to get close to accurate figures for all the known startup costs and monthly expenses. And I've left room for extra fields so you can enter anything else. Okay, so we've got the index instructions, and then we have, basically, so the base of the model is you have the light yellow tabs. That's where you build all your assumptions, and then all the blue tabs are the result of those assumptions. So let's just go through each tab, and then you'll see how it all works and see how you can use it. So Control tab, uh, real simple here. You just put in your start year and start month. Based on the start year, you could. This is just going to populate whatever monthly drop downs need to happen. For example, below, based on this being 2018, it's going to give you a ability to select months from January of 18 through the next 5 years. In the start month is going to um, define. Let's see. If we put this at January, let me see what I did here. That's going to define this first month. And then there's also going to be definitions for when you actually start revenue. So I mean, obviously you wouldn't want to put the start month of this to May, and then have. I mean, I guess you could. Let me see here. Is this even relevant? Let me see if this is even going anywhere. Okay, so no, we actually don't need that. So all you have to do is put in the date of the year you're starting. Doesn't matter the month and the day. It automatically gets converted into drop downs that go off of that year. Like I said, from January, you have January 18 over December 22. Okay, more importantly, uh, we have financing. So if you want to finance some of your startup costs, you can put those variables in here, and that will flow right over to this debt schedule, which populates, and then this also flows right over into the monthly and annual P&Ls for debt service. You can put 0 in here, not a problem. Okay, let's just put in a number. You pick the month that this starts as well, because it might not be obviously January or whatever during the year. And then we have capital requirements, and these are defaulted numbers that come up based on the startup costs and running cash flows. And what it is just picking a minimum on the running cash flow for leveraged and non-leveraged. We'll get into that more when we get further into the model, but it's nice to see right on the front. And then you could put in if you want to account for any reserve cash, and then this is your your amount that you need beyond the financing. Now, if you say you finance, say you get a bunch of financing, you don't even need that much. This is saying negative means there's no cash needed. You'll have plenty of cash after financing. You'll have basically 791,000 surplus even after including a 250,000 reserve that's just there. So you don't need that much financing. Let's say 1.5 million gives you about $188,000 cushion plus 250. So this is good to play with. You can see, if you're trying to leverage out the whole entire startup, this lets you see how much you are going to need. I mean, if you say you only need 500,000, and then you're going to have to come up with, in this scenario, about 1.2 million to cover the reserve. 918,000, just assuming all your assumptions are 100% accurate into the future. So that's that functionality. Then we go to the revenue builder. And so what I've done is you can do 20 different types of cars, and obviously there's way more than that, but the idea is to make this simple and but um, granular enough to deal with various types of cars being sold. So these types, car type 1 through 20, is going to be defined on the validation here. This is where you write in whatever you want to label these types of cars, and then that's going to propagate through the model. Um, so we have a car type 1, and in general, this is how I thought it'd probably be easiest to organize. Is you have your lower cost cars, mid cost, higher cost, and you're just defining your average markup for each of these. And so this is going to coincide right with the costs. So this type 1 of $500 coincides with this type 1. You mark it up 30%, the sale price becomes $650. So that's how that logic works all the way down. It's just that was the easiest way to make something, a model that would fit basically anybody, and you can just group your different cars you plan on selling into these average cost buckets, and you can define these amounts here. It doesn't have to be what I've put in. It's just to allow you to figure out how many cars you're going to sell of each type and what the margins look like. So that's for you to build out. Then we have the month start. So this is just saying January through 18 all the way out to December 22. You can pick when a given type of car starts. You're going to start selling it. This is useful if you say you want to start selling these in January. And then say some of these mid ones you want to start in April. We've done that. And then say you don't want to start selling the high end ones until say July of 2019. You can plan that kind of ramping up schedule, and that could fit all kinds of different. That's just another tool for you to build out scenarios. You can see if we change this markup, so say we put it to 100%, it means you're charging $1,000 for a $500 car. As you can see here, it's 500 and type 1 going to 1,000 with the 100% markup. And then we have the car sale count you project. So this is saying, in year 1, you plan on selling one of type 1 car a month. So in total for the year, you'd be selling 12 type 1 cars. You'd be selling 3 type 2 cars a month, which would be 36 cars a year for type 2. But that's how that logic goes, so you can kind of scale out how many cars per month you plan on selling of each type. And then you can change it for year 1 through 5. Then we have our costs. We've already went over the average cost. This is where you put in the cost of each type of car. We have our startup costs. So this is, and notice everything in light yellow is what you can change. Everything in white is formula. And so this is one of the more advanced logical constructions I've done in this model is the initial car inventory. So this is going to allow you to project what you're going to need up front to pay for a given amount of months of cars based on these projected sales. So this is saying, let's say you have 4 months out in time, you want to pay for the cars that you plan on selling. You want to pay 4 months ahead of what your projections are. So it's saying, let's go to our monthly here. The first 4 months you can see we only have 160,000 worth of, oh, sorry, those are revenues. 122,000 worth of cost of goods sold. So it's saying, assuming you do sell this amount of cars here, and this is all based on what we just built in the assumptions tabs, it's going to cost you 122,000. So you got to buy all the inventory right now. Hopefully you sell it. So that 122 is a startup cost, and see that populates if we do say 12 months out. So that's saying you're going to buy inventory that you think will last you for the first year while you're generating the cash from the sales. You can see here that will just be the full year here. So all of 18, 12 months worth, 690,000. Assuming you sell what you predicted or what you're projecting. So that's a startup cost. And then in the cash flow down below, if a month was included in the startup cost, it will not, that cost of goods sold for that month will not flow to the cash flow. So we're not doubling up on that specific item when we get down to the cash flow. Then we got rent security, so that's obviously just if you're going to rent a commercial real estate. You have to have, if you're doing a used car dealership, you have to have a piece of commercial real estate to get your dealer license. So that is a bit more expensive. It might be, who knows what your rent deposit and security deposit could be. I just put 3,000 in there, just an estimate. Then you've got to get bonded. That could be, it depends. Utility deposits, that's standard. Signage, just for getting your advertising up. Legal fees, possibly. And then we have a big item here, building land purchase. So this is if you don't plan to rent. If you're just going to buy the piece of land and piece of property, this could be maybe 500,000. Maybe you're constructing something, and then you would not have any. You'd put 0 in for nothing or 0 in for rent, security deposit. And then that would just add to your total startup costs, cash needed. But for now, we'll just leave it as is. So those are the startup costs. Then we have our running costs. So this is if you've got to run the thing. So you've got to keep the lights on. You got repair and maintenance. Now this repair and maintenance is actually, this is for car repairs. So assuming you buy used cars, you might have to repair them before they can even be sold. This is the estimated amount you're spending per month to do that. So it's just a provision, just to plan out what you think you might have to spend. Then we've got the commercial dealer license, dealer insurance. So I saw things around 20,000 a year, so that's 1,700 a month. So that's just what I put in for that one. You've got your rent, assuming you are renting a spot, anywhere from 15, 17. That's probably average for one lot for commercial real estate. And then we've got utilities. Just put in a number there. That could be whatever. And obviously we have it changed. You can change it each year. Bookkeeping, admin salaries, secretary, other personnel, salesmen. I haven't done salesmen on commission at all. I've just done them purely on what you think they're what you're going to pay them each month. Now you could bake some commissions into there, just assuming they're going to hit certain marks, but that can change every year. This is a monthly number. And then you've got other running costs. So if you want to have other things that you want to plan out, you can put them in, enter them in here. And these are all these. I probably should put these in light yellow because you can adjust these right here without messing anything up. Except for that needs to stay inventory for cars. And then you can see the car types are all pulling because those have to be the same, in the same order to make sense, so you don't enter them in there. We also have the month start, so this is saying, hey, I might have salesman 1 starts right in January. Salesman 2, I don't want to start until, say, July of 18. Salesman 3, I don't want to start until, say, February of 19. And even if there's numbers in here, nothing will populate if you have the start month. In July, nothing's going to populate on the P&L until July of 18 for salesman 2. Right. So that's basically how we build the business case. Then you've got your executive summary. This is a high level based on your assumptions. Look, you're going to sell 210 cars for the first year, 492, 816. Thousand up to 1,300 cars for 2022. Here's what the revenue from those cars would look like. Here's your cost of those cars just to buy them. Then you've got gross profit margin. Then you've got your fixed costs, and you can see here, based on these assumptions, you're actually going to lose money in the first year, but then you start making money. Then debt service, if we're going to finance some of those startup costs, you got to pay the debt. Then we've got leveraged cash flow, non-leveraged cash flow here. Leverage just means it's assuming you are financing. Non-leveraged is not financing, so this is basically the same as EBITDA if there's no other non-cash, expenditures, which I didn't really put in for one-time costs um, that happen throughout the year. So you could try to plan that into this schedule or into the startup costs, and it'll just happen at the beginning. Um, but it's just for simplification and to get a tool that really everyone can use and understand and function and make work pretty easily. Then I got this metric. It's called EBITDA generated per car. So it's basically saying, assuming you sell 492 cars here in 2019, you make $2.8 million. You end up actually only keeping 145,000 in this scenario. That means every car that you sell, you're actually generating 200, about $300 in profit or EBITDA, which is earnings. It's basically profit before any interest, taxes, depreciation, amortization. All we have is interest and amortization here. We don't have taxes included in any of these calculations. So I thought that was an interesting metric. And you can see that goes up because the car sales start to outweigh the fixed costs. And that's why this goes up. And then we've got some charts here, revenue, gross profit, EBITDA. And then we've got your revenue versus expenses. So this is your revenue, and then the orange would be your cost of goods sold. So what you're paying for the cars, and the other color. Note I am half colorblind, so sometimes the colors are hard for me. This is your fixed costs. So it kind of stacks up what you're pulling in the top line versus what you're paying out. Okay, so that's the executive summary. We've got visuals here. So the first two are cash flow visuals. This is just saying what is your accumulated cash in a leverage case. So this is assuming you're financing some of the startup costs, so you're actually only going to put out X amount of cash at the beginning. Now I've also added your position including the debt owed. So you can see this does not get as high because it's assuming it's your net position. So here, even when you start, you still owe a certain amount of debt, and you have to pay a certain amount of cash out. So you're starting here, you're losing for the first couple months, so it's going down and down. And you start making money, it goes up. But at any point in time, this is saying, these bars are saying when what your cash position is if you paid off all your debt on that day. And you can see right here in the late 2000, actually early 2020, is when you have basically have enough equity that you could pay off all your debt and not be, you don't need any other cash. And then you start going up from there. And then the blue line is just your cash flow, assuming you're not paying back any of the debt, and that's what your position is with that. And you can see it obviously starts a lot higher. You don't start as far in the hole, or I mean, it's the same position, but the actual amount of cash you have to come up with at the beginning is less, out of your own pocket, and then it's just the difference here is just your debt, the difference between this position and that line. Then we have our non-leveraged accumulated cash. So this is assuming a scenario where you're not financing anything. You're putting all of your own money up front, and then you're running the business. So this is what happens. You see break even around, again, late 2019, early 2020, and then you start really building up a cash reserve. Then we've got two other charts here. I did car sales per month, so you can just easily display how many volume, what your volume is per month of these cars. Pretty simple chart there. Um, Actually, I wonder if I want to change this to a line or an area. I don't know. Can I make that look cooler? There we go. So, car sales per month. And then we've got the cool metric I kind of built into it, which was EBITDA generated per car. So, obviously, the first year we're losing money, so we're not making anything per car. Then it starts going up. So, those are the visuals. We got return summary. This is internal rate of return. Obviously, the leverage internal rate of return is going to be higher because you don't have to put as much cash up front, and then as long as you're making more than the interest, it's going to be higher. It's going to be a higher rate than your non-leverage. So non-leverage is saying it's lower because you have to put more cash up front. Your cash requirement is higher. Even though you might be getting more back in the end, you could see the net cash return after debt repay. Your non-leverage is obviously going to be higher here. Because you don't have any debt. So here you do. We've also got net cash. So net cash return. So this is money. This is saying, say if I have 10 million in the bank, I invest, whatever I get, invest 240,000 or 730,000 into this business, depending on if it's leverage or non-leverage. At the end of the 5 years, say I started with 10 million in the bank. Now I would have 13 million here, or 12.7 million here, and 12.9 million here, actually, not 13. So that's your net cash return. So it's the amount of money you get back plus your initial investment. And so that is, you can do a percentage of that, which here it's 1,237%. Here's 368%. Basically saying from the amount of money you put into it, you're actually getting back about 3.6 times plus your initial investment. Net cash return. So this is just putting the dollar amount into yearly. So it's saying basically you're making 500, almost 600,000 a year here. Here you're making a little bit less on the net, and that's because you're putting more up front. So you don't get to your net return. You're getting a little bit less bang for your buck. But you're not in debt at all, so there's trade-offs going on there, and these will change based on your assumptions. So then the net ROI, this is just taking the percentage into a yearly number. Then remaining debt, obviously non-leverage would be 0. This is saying that after 5 years you still owe $470,000. So if we take that off of the 2.9 net cash, you get to this, and obviously this doesn't get reduced from that. Those are the returns. Discounted cash flow. I just did it on EBITDA for this model. It made sense. So we've got annual revenue at the top. You got EBITDA at the bottom based on how much you're making. Then we're discounting each of these EBITDA based on this discount rate and what year it is out in time. So it's saying your future expected earnings are 2.7 million, but discounted at 15%, they're actually about 1.5 million. And then also at the end of the 5 years, assuming you're going to sell, the business has some kind of value. I've done two. You can basically pick either a revenue multiple or EBITDA multiple. If you do EBITDA multiple, it's going to take your EBITDA times this multiple to get this number. And then that also needs to be discounted back 5 years. And then to get the actual the enterprise discounted cash flow value of the next 5 years, we're just summing up the present value of all of these future cash flows, including the sale. Now again, if we put a revenue multiple on here, this is going to then be much higher because we're taking 50% of 8.7 million as the value of the business at year 5. Now you might only have say a 25% multiple um, on top line revenue, or your EBITDA might be 4 or 3. You know, someone's willing to pay you for your business 3 times what its annual EBITDA is. So that's how you kind of come to an discounted cash flow value for the enterprise, based on today's based on starting today and the next 5 years. This is what is we're projecting is worth. Okay, then we have our monthly P&Ls. So these all go on the assumption you can see here. When I started in Type 7, there's no sales until April. You can see that here. So Type 7 is, yep, that's the month we changed to April. Let's say I put that to July. Now look, there's zeros up until July. So that works perfectly. And that's for, you can do that for all the types are affected by that, and then it goes out in time. You can see we're starting, these start, type 15 and down starts in July of 19. Then we've got the dollar sales. So this is just taking it's dynamically looking up the amount of cars you're selling based on the sale price of the car. And that all also corresponds with when you actually start selling the cars. So it's all dynamic. Then you get a monthly revenue from that. Then cost of goods sold, basically the same logic, is you're taking the amount of cars sold times their cost to get the cost for each type for each month, and you get a monthly total cost of goods sold. Then we've got our gross profit margin. Then we've got our monthly fixed costs. You can see here salesman 1 and 2. We started salesman 2 in July of 18, salesman 3 in Feb of 19. So those when those costs start. So that gets you to a monthly cost per year. Then you've got our EBITDA monthly. We've got our monthly debt service coverage, cash flow after that. And then this is the logic for the inventory prepay. So obviously we still have it set at 12 months, so 670,000 worth. And now here's the interesting part. This cash flow after debt, it already is reducing the cost of goods sold here, 17,000. So since we already have that 17,000 baked into the startup cost, since it falls into the amount of months we're projecting out or we're paying for, we have to add that back in. So this number adds that back in, and then you stop adding it back in and just put it in the regular flow as soon as you stop with the as soon as you get past this number of months that you enter here. So if we put this to 7, you can see on the monthly this changes now. Look, it's month 7 is the month that you're paying up to for the projected sales. So now it's a little bit less, 324,000. You can see that inventory flows into here. It's actually starting initially. This is where it's summed at. So then we have our startup costs, and then we have running cash flow leverage, accumulated cash leveraged, and then this bottom one is where we're adding back the debt owed. So you're actually not into the positive equity until here, March of 2020. You actually have paid off, or you actually have more cash accumulated than you have debt at that point. Obviously, no leverage. There's no debt component, and you're getting a little bit more per month. You can see 56,000 instead of 52, and that difference is just because you're not paying any interest or principal back. But then at the start, you can see this actually, we're starting at a positive here, 152,000. Here we're still negative 347, because here we have actually borrowed more than our startup costs. So startup costs 347. We've borrowed 500 now. If we put this down to say 150,000 for debt and look at it, well, now they're all negative because we still need to come up with this much cash, even if we do get some financing. And all this is all dynamic based on all your assumptions. Okay, so that's the monthly. Then the annual is the same thing as the monthly. It's just rolled up into a year. So it's showing you everything that we just went over, but um, on a per year basis. And that's that. That's the model. And then here's the debt page. So if you want to purchase this, obviously, it takes me a lot of time, and I've invested thousands of hours into being able to build something like this. And I only request a one-time payment, and I'll send you this fully editable model if you want to try to play with it. My cost $45. It'll be a mid-level model. That means you just pay that one-time fee. I'll have the link in the description box below that leads to the smarthelping.com page that will have this mid-level model. And then upon purchase, I'll see that you uh, you bought it, and I'll send you the email you the template to the PayPal email. And I guess that's about it. Can't think of anything else. We got our definitions here that shows just different things that you might not know. Then we've got our explaining each tab in a quick summary. Uh, I guess that's it. I'll see you on the next one.